Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with the main man, all the way from somewhere nice and sunny, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help answer your questions, and they're there to give you advice. So there's the disclaimer.
All right. Before you get started on today's discussion, I wanted to share a photo that a chameleon shared with me last week, and I forgot to share it. Can you see that?
Yeah.
We were talking about Nixon last week and how, out of Nixon's administration, there was a terrible years of inflation that it took a long time to take off.
Yeah.
But he shared this photo with me, and I'll just put it out there. Third from the left. Can anyone guess? It says Nixon Lodge on it. Who that is? At the end of the show, I'll reveal it. But such a great classic photo.
I don't know who that is.
Well, I will share at the end of the day, at the end of the show. And remember, we have a webinar today at 2 p.m. with on IBKR. So, and that's going to be on the options chain, I think.
Yep, we're going to talk about the options chain, and we did make an update yesterday on the overhead on the options chain, so I'll mention that today as well. So I'll go over that during the webinar at 2 p.m. with Interactive Brokers. And if you want to join, you have to do it through Interactive Brokers. We have a link there, but they're hosting that webinar, so it's not going to be on YouTube like this one. It'll be within Interactive Brokers.
Yep, and I'll put that in the chat as well.
Okay.
All right,
thanks,
great.
Will. Let me share my screen. If anyone has a question, you want to put it in the live chat on YouTube. Will's monitoring, he'll read them back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you get to Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, everybody will be able to hear you, but you can ask your question directly that way. While we're waiting for questions to queue up, I think what I'll do is go over the pre-market report, see what's moving in pre-market hours. Maybe we'll navigate to the earnings, see what earnings are coming up. I had a question about unusual trades or block trades, so I might cover that. I might show you guys something in there as well to help use. A lot of people go to that block trade screener, look for ideas, look what's trading, and try to interpret what happened. So I'll give you a couple examples that you might be able to use to help you with that. So let's start out the pre-market report. Will, if we do have questions, let me know. Stop me and I'll take the questions.
Perfect.
All right. So pre-market report, these are stocks trading at pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. 38 stocks made our percentage gainers list, 58 on the percentage decliners. So from this perspective, we're looking like a slightly bearish bias at the open. I'm going to filter out this list to S&P 500 stocks to see what's going on there. So we're taking out ETFs, leverage products, closed-end funds, preferreds. Let's take all those out just to focus on S&P 500 stocks. And I'm going to use this filter here to filter out this list. So in ETF, I'm going to drop it down. I have a list of ETFs. When I select one of these ETFs, the list below will get filtered by the holdings in that ETF. So SPY, S&P 500 ETF. Here we see 5 stocks made our percentage gainers list, 12 on the decliners. So here again, from this perspective, we're looking like a more bearish bias at the open. List isn't huge, but nevertheless a little bit more bearish. I think we have PPI numbers coming out tomorrow, CPI numbers the day after. Of course, that is going to be important. People are watching it closely, looking where the inflation is heading and how aggressive the Fed will be. And I think that the Fed right now, even though those PPI and CPI numbers are important, it's how those prices are distributed there. What's going on in the PPI, CPI, and part of like the problem when they thought it was transitory, and they were looking at the numbers, and the reason they thought it was transitory because in the past we've had volatility in prices. We've had volatility, food and energy, even in housing prices, could go in commodity prices, and we've seen prices go up, and the Fed did not have to do anything necessarily because eventually, and prices are signals to the economy that the supply side caught up with the demand, right? So sometimes that's healthy. The economy, it's signaling something needs, either is being underproduced or there's a demand climbing, let's say in housing or somewhere else, and then it takes some time for the production forces to catch up, and then the supply and demand meet and things come down. Here, I think that it's the CPI and PPI are important, but now you want to dig in there, see how those prices are distributed, if it's concentrated or distributed, if it's widespread. And the big thing is, I think, the tight labor market. As long as we have a tight labor market, it's going to be an issue for the Fed, because that inflation is sticky. It feeds through the economy and it keeps filtering through. You're getting income, you're spending your money that contributes to somebody else's income. They spend money, contributes to somebody else's income, and it keeps inflation elevated. So that tight labor market, even if the CPI maybe is better than expected, I think that they're looking closely at it, and they want the labor market, that labor. You don't need 2 job openings for every 1 person looking. It's going to be an issue. You need a better equilibrium, and that will be the big. I think at this point that might even be a bigger number to watch. What do you think?
Yeah, I think you're absolutely right.
So the wage inflation, they mentioned that, the Fed mentions that a lot of times, that they're looking at that labor market's very tight, and they're concerned about wage inflation. So
the problem is, I mean, from the government looking at it, right? You've already heard complaints, is to get that number to where the Fed is happy with it, people have to get laid off, right? And
unfortunately, there's
that's the real rub, is constituents have to suffer in order, and we'll see how it plays out, but
they're right. They have a tough job right now, especially where now they're gonna be faced with, there might be deflationary pressures coming from commodities, like maybe oil, lumber, and people will look at that and they say, well, hey, maybe you don't have to tighten, maybe you have to loosen. Why create the inflation? Why continue to fight inflation? And those prices can be volatile, right? The oil prices could come down, then they could go back up. And in an inflationary environment where expectations continue to be that dollar is going to lose value, and everybody has a job, that the savings that are coming from lower gas prices, the savings that are coming from maybe lower whatever prices, though that money can be spent elsewhere in the economy, pushing up prices again. So, when you have this widespread inflation, even if you have certain things coming down, that may not bring down, it's not going to create price stability, right? They want price stability. They don't want, prices shooting up and shooting back down all the time, it's going to be a problem for the economy. And they're concerned about creating stagflation, right? What if we go into a recession, but inflation's still a problem? So even slowing down the economy, even pushing it into a recession, may not bring down the inflation. That doesn't necessarily have to be the consequences, and they're worried about that too, watching close. So maybe going fast at a faster pace is better than in a slower pace, because you don't want to just kind of slowly walk into a stagflation. So those numbers will be important in what they say, what the Fed, and I think they're speaking every day at this point. You hear they're out there, trying to convince people we are looking at the data, and when it was transitory, when they said it's transitory, it wasn't data driven. It was more of their interpretation of what's happening, right? So you have the data, and then you have an interpretation of the data, and their interpretation was incorrect. So you have those things going on. Let's look really quickly. I'm going to try to cover two things. Remember, today at 2:00, we are doing the webinar with Interactive Brokers. That will be on the options chain. One of the questions I usually get is here. I'm going to go here on an option block trade screening. And these are large block trades, large trades that we define, by our definition, has to be over $10,000 in notional in a single trade. And we list the trades here that meet those conditions, and people come here to screen, sometimes to see what's going on, what is trading, maybe get trade ideas, maybe get in, see which way the order flow is moving. And the question that comes up, well, how do you know if somebody bought an option, sold an option, which way they're moving with it? And we talked about this, that's part of our option order flow sentiment. And we have different rules. So there's no one way to really, or one rule that you could use if you've been experienced and traded a long time, especially from the market making side of it, like we did. It's not as simple as sometimes people say, well, here's the trade, here's the bid, here's the offer. So if this trade at 460 traded on the bid, that means that an end user sold it to a market maker, right? That's the most simplest, basic way to look at it. It's not completely accurate, but I don't think over the long term you're going to get the accuracy that you want. So we create more rules in place. And the reason why it's not that simple is that the bid and offer themselves are comprised of the market maker and the limit order book. Okay, so you have two things there. In a limit order book, anybody can put in a limit order. It's not just the market maker. Anybody can put in a limit order if you have access to the exchange. So you could go in there right now and put in a bid for $4.61, and that will get displayed. And if the market maker sells it to you, then you bought it. So it wasn't a seller, it was actually a buy order. So one of them is that there's a limit order book, and a lot of people are putting in limit orders at this point. There's a lot of trading going on. So then you have to kind of make more interpretation of, was that a market maker quote that an end user hit, or was it a limit order from an end user that the market maker then swept, right? Or somebody else swept. The other thing is that some of these trades are negotiated, and when they're negotiated on the floor, they could be put, they're negotiated, they're traded, and then they're put up, and the market can be moving while, it's not instantaneous. It's not like an auto execution. So floor trade may go up 1 minute, 2 minutes, after the actual trade occurred, right? So we won't see it immediately, because what happens is a broker comes up to a specialist, negotiates a trade, they agree on it. So the trade happened. While they write up a ticket, give it to the specialist has to manually enter it in because it wasn't auto executed. It takes some time, the markets can move and so forth. So a lot of things are going on there that what you will hear as well, the simplest explanation, because it's easy to explain. You don't need any rules. It's not complicated, but it's not necessarily accurate. Now, I can't go over every rule that because we have like 50 different things that we follow. But one thing that could help you out as well is, let's just take a look at, I'm going to look at maybe single trades, so these aren't going to be multi-leg trades. But these will be single trades. And what I did was I filtered out the single trades and I just sorted it by the highest notional trade. And we see here's one, AVGO, 1121, 460 put traded. It looks like, again, 460 put traded in AVGO. And it kind of traded in between the markets, right? So this was a floor trade, got a price improvement, traded on 2 different exchanges, but it traded around here, 1121, 1119, 2,500 options here, 1,333 here. And we do see that, okay, here was the bid, here was the offer at the time. Since it's a floor trade, I'm assuming that this was negotiated, took a little bit of time to put up. So I don't even know where the market was at the moment of the trade, right? Could have been a minute, delayed, 2 minutes delayed before the specialists put it up. And then you could see here, another one went up. Well, this one went up 1119, one went up 1128.18. So we could see it's a big trade, 1,033 contracts, and it's a 64 delta, right? So that's a pretty big delta. Whatever over what is it, like 70,000 shares of stock, then there's 2,500 contracts there, also 65 delta. So huge amount of stock. And if we think that the market maker was on the other side and the market maker is going to stay neutral, then they would hedge this option with the stock. Okay, so we're going to look for clues. Did they hedge in which way? So if they sold a put, we would think that then they went and sold stock in the amount of the delta to get delta neutral. If they bought the put, they're going to buy the stock, right? So did this trade potentially create a hedging event in the marketplace, right? So that's what we're going to look like. We're going to look for clues. Did it create a hedging event? And if it did, and we notice it, then we have a better idea which way the order came in and what did the dealer put on his books, right? So we want to see, what did the dealer put on his books and what did the end user try to do? So let's see if we could find that. So I'm going to go to AVGO. Let me see if okay, and I'm going to, and this is where I'm going to show you the VWAP table. So we have a minute VWAP table. Some people know how to use it, some people don't. And when I go to this VWAP table, by the way, you're going to see things on my screen you're not going to see on yours, so don't worry about it. These are features that we build that for the future. But you're going to see your VWAP table right here. And what this is every minute, right, minute by minute, we give you stats on the number of trades, the volume that minute, and the price, the VWAP price. And we could use these benchmarks to make an educated guess. So what were the times that I said? Well, 11:19, 11:21. So let's look around that. So I have to go back to 11:19. And the reason I'm showing you is how you stitch data together, right? To make, so here's a couple things we see, right before 11:19, I'm seeing around, just jumping around 3,000 shares, 10,000, 5,000. Here's an interesting one, 31,000. So that's a big one right at 11:18. Let's see what else happened. 11:19, another 33,000, 14,000, and then it. So if I look at this increase in volume, I might guess that they started hedging some of that delta off, right? So which way did they go? Well, my first clue, right, is, well, what happened to the VWAP? If you're creating selling pressure, right, then the prices, unless you're lucky and there's a big bid there, the prices are going to move down, right? So you could see here, right around 11:18, we see a big increase in volume, right? 31,000. So right before there was 5,000, before we do have a 31,000 here, but we do see right here, big increase in volume, 11:18, 31,000, 33,000, 14,000, kind of backed off a little bit. So we got like a climb on low, but the bigger volume, right, was all on the downside. So if I just use that piece of information, right, that would weight that the user who provided the liquidity in that option, if they went to hedge it, they're hedging it by selling stock, right? So the liquidity provided market maker, to stay delta neutral, probably went in there and sold some of that delta out. And it's not even all that delta, because you could see from what we're seeing here. What do we see here? That this is 64 delta. So just over here alone, right? That's over 70,000 shares. He had more to go. 65 delta, 2,500 shares. So that alone is, 150,000, something like that, delta. So they looks to me like they did get rid of some of the delta, probably held on to some more, because they had more to go. If you imagine that it was all, all delta by one person. If there are no questions here, let me go to.
Hey, D.
Yeah.
We did have a question, and it's relative to the IV. He was asked. Alex was asking, what is the significance of IV percent rank? He says the colors also change with more volatility, I suppose. That wasn't part of the question, but that was in the whole comment. So what, in your opinion, what's the significance of IV percent rank?
Okay, where was he looking at? Here?
I'm assuming it was on. Yeah, there.
It basically, so, and we talked about the IV percent rank actually yesterday, but it's a way to measure how high or low the implied volatility is relative to a historical benchmark. So if I went here, maybe an easier way to do it is this. If I'm looking at Meta, right, let's just say Facebook, and I say, okay, the stock is 133. Well, if I never looked at it before and I don't know anything about it, I could say, okay, on a relative basis, is it high or low where it traded in the last year? So I could look at the 52-week low price, 52-week high price, and I could see, well, it traded as high as $353, as low as $132. So right now, it's trading near its 52-week low. So that's price. Usually as a trader, professional trader, you'll look at the relative valuation of it. So not just price, but a valuation could be like PE ratio, price to sales or whatever. But let's just keep it at price to simplify it. So now I kind of know that it's trading near its 52-week low. But the options, I can't really tell, if I look at this option, 135, this option here, is it at a low price? Is it at a high price? That is not easy to say, right? And what is a low price and a high price? Because the option itself is moving around based on where the stock price is, right? And the option itself loses decay every day, right? So every day, today is 19 days left to expiration, tomorrow is 18, the next day is 17, 16. So it's decaying every day as well. So how do I tell if this option here is trading near its high or low range where it usually trades, right? So similar to this, except not exact, because remember, we're looking here at just raw price. As a professional trader, you would say on a valuation basis, it's a near a high or low point. So what we do with the option is we convert it to a relative value, which is implied volatility, right? Implied volatility is telling us how high or low the premium is, right? So we're not looking at just the price, we're converting it to the premium. Basically, based on this price, if I put it in a Black-Scholes model, the Black-Scholes model is saying that with this many days left to expiration, with the strike this far away, stock price here, dividend, interest rates, all that, I plug it in, and then I come up with an implied volatility, which is basically telling us that this price is indicating that the stock will move at a certain volatility into the future. So we could continuously do that. And to measure if this is a high or low, we capture that implied volatility. And then we look at historically, well, what were the options, the implied volatility in the options with 19 days to go, stock price this far away, the same distance away from the strike price. And we look at it historically, and now we have a sense, well, this is telling us that right now we're on the high end because all our observations that we've seen were below these implied vols, right? So here we go. We're at 69 right now. Well, this is the bid. This is the offer. Here was the average, the median, the high. So it just set a high and the low. So now we could see that it's on the high end of its historical level. That's the significance of it. Does that make sense to you guys?
It seems to make sense. It's helpful.
Okay, so we are right at 9:30, but I'm going to be going over the options chain today. Okay, so I will be looking at this today. Maybe I'll cover this again. Couple new features up here and that we'll talk about. That's going to be at 2 p.m. with Interactive Brokers.
Yep, and I put the link. It's at the top of the YouTube chat, everyone. Great job, Dima. Chuck, thanks for sharing that picture from your football playing days. That was awesome. D, great job, my friend.
Will, you told us you're going to tell us who's in the picture.
Yeah, it was Chuck Anderson from Minnesota.
It was.
Yeah,
okay.
It was actually Mike guessed it right away. So,
really?
It was guessed early on, but it's a great photo and such a great piece of Americana, right? I mean, it's presidents used to go to. I mean, in our area, the football was PAL football, but Chuck said it was it was the city football league they were playing in, and they were campaigning against JFK's. So it is interesting. I mean, it's just such a great bit. And, we were talking about last week about, what came out of the Nixon administration and into the, then Ford and then Carter. I mean, I was so young at the time, but not that I'm that young, but I was born in 68. So, I wasn't really following what was, but by the time you got to the 80s and 90s, we were still dealing with the inflation issues that came out of the, 70s. Right. And, so, and we're going through something now, that's for sure.
Yeah, definitely. Well, everyone, we're going to let you go. Hopefully we see you at 2. Stay safe out there. Have a great trading day. If we don't see you today, maybe tomorrow.
All right. Thanks, everyone. Great job, D, as always. Have a great day, my friend.